Hi, I'm Shaz Nawaz. I'm a property tax accountant and a business owner. And today we're going to take a deep dive into the exciting world of property investment. Whether you're a seasoned investor or you're just starting out, a beginner, a newbie, call it what you like, I'm confident that in this video you'll have some valuable insights which you can use. Now, I've always been of the belief that property investing is a powerful wealth building tool which has a rich history of success, and it helps you to build financial freedom and create intergenerational wealth. And obviously it involves buying properties, generating rental income, and then having some form of capital appreciation, and obviously there's moving parts in between in terms of redevelopment, refurbishment, financing, funding, JVs, and many other things. But that's just the tip of the iceberg, by the way. So let's go into some of these things in a bit more detail so that we can explore them further. Now, before you embark on your future property journey, whether you're new or an existing property investor, you need to be clear on your investment strategy, and this needs regular work. And this strategy really is a roadmap which leads you towards your success. So regardless of which strategy you choose, you need to know a few things first, in my view. Now, to create an effective strategy, consider the following points. Number one, look at your financial situation. Before diving into property investing or diving any further into property investing, thoroughly evaluate your financial position. Consider factors like your savings, credit score, borrowing capacity, exit strategy, how much income you need, what business structure that you have, so that you've thought about everything in detail, and determine how much you can comfortably invest without jeopardizing your financial stability and situation. And I think it's essential to have a clear picture of your resources so you know exactly what you can achieve and where the gaps are and what support you need. Second, risk tolerance, and this is different for every single person, by the way. Understanding your risk tolerance is important because the way you perceive risk is different to how somebody else perceives it, and how you react to market fluctuations and all the other moving parts in terms of changes in the law, regulation, property maintenance, tenants, etc. is going to be different. So you need to work those things out and see where your boundaries and your red lines are. Third, have very clear investment goals, and you need to define those goals. And are you, for example, thinking of long-term capital growth as your main driver, which I don't think you should do? Are you thinking about regular rental income, which I think you ought to? Or are you looking for a combination? Are you looking at conversions? Are you looking at single lets? Are you looking at service accommodation? Are you looking for a mixed strategy? Again, these things you need to be very clear on, and then deploy the ones that work for you. Fourth, you must do market research. So conduct comprehensive research on your property market. The more you know, the wiser you'll be and the better decisions you'll make. Identify areas where there's growth potential and strong demand for what you're looking to do. Consider factors like employment opportunities, infrastructure, development, local amenities for where you're looking to invest, and this is going to be obviously your gold mine area. A well-researched market can significantly impact the success of your property business. With that in mind, let's look at the pros and cons of a few of the most common strategies. Buy and hold, which is usually single lets or buy-to-lets, but it obviously can be HMOs, houses in multiple occupation. This strategy involves acquiring properties and then obviously holding on to them and renting them out on usually a 6-month term. The benefits are that it gives you consistent rental income as long as you have somebody occupying a property. There's potential capital appreciation over time, and you've then obviously got a very simple, clear business that you can monitor. The downsides are that it requires substantial initial investment. There could be property maintenance and property management responsibilities where there's a cost, or you need to put more time into it yourself. There's market fluctuations in terms of property valuations, rental income, and also the additional costs that are going up alongside regulation. Fix and flip strategy. Investors follow this strategy purchase usually distressed properties, renovate them, and then which increases their value, and then they sell it for a profit, and some obviously may refinance and hold on to them. Advantages are that there's a potential for a good margin in return in a very short time period, and there's an opportunity for you to improve the neighborhood, and there's also an opportunity for you to refinance if you're going to hold on to it and get all your money out. The downsides are renovation costs can go above budget, can be hard work, market conditions may affect your sales prices, interest rate changes may make it harder for you to get your money out. So these are the things that you need to bear in mind. Real estate investment trust, REITs. REITs offer a way to invest in real estate without owning physical properties yourself. The pros of this are they can provide diversification, liquidity, and the potential for passive income through dividends. REITs also allow investors to access various property types and locations. The cons are investors have limited control over property selection and management decisions. Dividend income may fluctuate based on market conditions, and there's potential for market correlation risk. Lease options. Lease options enable investors to lease a property with an option to purchase at some point in the future. This could be 6 months, this could be 5 years, this could be 10 years. The period changes depending on your agreement with a particular seller. The benefit of this particular strategy is that it requires less capital upfront, and it may include rent credit towards the purchase and offers flexibility, and it gives you time to save up for a deposit. The downsides are that you might not be able to exercise the option, which means you might lose out at some point in the future, and you might do a lot of work right now for not too much gain at some point in the future, and you're going to be doing quite a bit of work up front, which again might not benefit you in the long term if you cannot exercise your options. Short-term lets or serviced accommodation. This is an excellent strategy for increasing your rental income on a monthly basis, particularly if you're in a destination where there's a lot of footfall or it's a tourist destination. Offers you flexibility, adaptability, and excellent cash flow. The downsides are it requires a lot more hands-on management. There's a lot more going on. There's more, depending on which area you're in, there's more regulation in terms of the council, in terms of how many days somebody can stay in there. The things may fluctuate in terms of an area may be popular at one point, and 6 months later there may be some other hotels opening up there, or there might be other people doing service accommodation there, which reduces your demand. But that's in any business, by the way. Commercial properties. Commercial properties typically offer higher rental income if you buy right, and this can be more than residential properties, and it also gives you an opportunity to have longer term leases in place with tenants, and you can have mixed use properties, so commercial downstairs, residential upstairs, and like I said, the return can be higher and should be higher, by the way. Some of the downsides are commercial transactions are more complex, and they can require more upfront deposits and investment, and when the market changes, that can have an impact on how long your property is vacant for, and it may impact the rental income. Property development. Property development involves building or renovating properties for sale or for rental. It offers the potential for substantial profits if done right, especially in high demand areas and when the market's going up. The downside is that it requires significant capital investment and expertise. It requires a lot of work, and it carries market risks relating to supply and demand, fluctuations in terms of interest rates, construction costs, and development projects can also take a lot longer to do because there's so many moving parts. Deal sourcing. Deal sources act as an intermediary, finding, well, they should be finding off-market properties and selling them to other investors. Some deal sources just take what's on Rightmove or elsewhere and take the lazy approach and start selling those properties to you. Stay away from those type of deal sources, by the way. The good thing for this type of business is it requires low capital and can have very quick returns as long as you can obviously close on deals. The downside is success in deal sourcing depends on your negotiating skills and how good you are at finding motivated sellers. and how good you are at obviously closing deals. Commercial to residential property conversions, my favorite. Here you've got potential for high rental returns. This is often due to increased demand for residential properties, especially in well located areas. Converting a commercial property into a residential property can lead to a transformation of the property's location, and if you're done right, you can get all your money back if you refinance, again depending on market conditions. And commercial conversions contribute to adaptive reuse, which can be environmentally friendly. It repurposes existing structures, reducing the need for new construction and conserving resources. But obviously you could be doing an additional extension on the side or the back depending on the type of property that you have. But let's just agree it's a pure conversion and no addition. For property investors with a commercial property portfolio, adding residential units through conversions can provide diversification, spreads risk across different property strategies, and can help you improve and increase your rental income. Something you need to be aware of, you may need planning if you don't have permitted use, so you've got that. You've got building control, which you need to be aware of. There's other regulation, including health and safety, that you need to know about. There's a lot of moving parts. It can take longer, it can cost more, and you need to build that into your plan. And this is a huge resource intensive strategy in terms of cash, so you got to make sure you have the cash buffer available. Now, the success of conversion projects is contingent on the local housing market demand for residential properties. If it's an oversaturated market, that can lead to difficulties in finding tenants. The condition of commercial property may significantly impact the feasibility of a particular conversion. So you should look at that feasibility study at the start, not after you've completed. Properties requiring extensive repairs or improvements could result in higher renovation costs and require longer project timelines. So you need experienced people around you who can advise and guide you on that. Property owners may need to deal with issues like tenant turnover, maintenance requests and costs, lease agreements if you're leasing out to one particular company to look after the entire development for you. The conversion process can be complex and it involves working with possibly planning consultants, architects, design consultants, lawyers. There's regulatory compliance, and then you need to obviously coordinate in between those professional people that you engage, and that requires management too. Property crowdfunding. This allows investors to pool resources and invest in properties collectively, which lowers the barrier to entry. It offers diversification and the potential for passive income. The benefit of this is investors have limited control. The downside of this is investors have limited control over property selection, and returns may be subject to market risk to some extent. Fees may apply, affecting overall returns. To illustrate the potential of a property business, let's take a look at a real life example. A project that I was involved in, the property was purchased for £375,000. Legals and other purchase costs were £10,000. The refurb was £500,000. Interest on doing the development was £85,000. All that added together gives us, I believe, £970,000, which was the money invested through own monies and external funding. A JV partner contributed £37,500 towards the purchase. The balance was funded through a loan. The refurb and legal costs were funded by the JV partner, and the end value of that particular project was 1.625 million. It was refinanced for 1.07 million, and all the money was paid back, plus there was 100 grand left over for the investors and JV partner. It was 21 flats, 15 one-bedroom flats generating £117,000 per annum, 6 two-bedroom flats generating £54,000 per annum. So total rental income, okay, if everything's on rent, £171,000. The total outgoings, including refinancing costs, were just under £70,000, giving a profit of just over £101,000. That's just one particular example of how you can make this work. And remember that success in this field requires careful planning, a clear strategy, and the ability to adapt to changing market conditions and the changing needs of your particular development, because things can go wrong, and when they go wrong, how you react to them is as important as anything else that you do. And it's never plain sailing. People think they're going to buy a commercial property, either use prior approval or permitted development, or get planning, and then they're going to call builders in and they're going to fix everything perfectly, to time, to budget, and it's all going to be plain sailing. That could not be further from the truth. You're going to envisage many problems. The more experience you get, the better you get at being able to address those problems, and the better you get at making sure that you avoid those problems by making sure you do things up front. So it's an interesting world that is called property, but it is also challenging. And I hope you're up for the challenge. Any questions? Put it in the box below. Click like if you like the video, subscribe so you kept updated, and I hope the video was of some use to you.